Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Chad here, your hosts for this weekend show. A lot for us to cover with U.S. markets continuing to show quite a bit of weakness. Boy, oh boy, this week was dominated with political news, tariffs, mostly focused on tariffs. We also had Trump's speech to Congress. That was a wild ride, if you ask me. And then a lot of economic data ending the week with jobs numbers. But again, these markets seem so focused on tariff news and, quite frankly, watching this correction that these markets are in. We'll call it a correction for now, but who knows how much deeper it could go. In the first half of this show, we're going to focus on the broad averages as well as some of the other sectors like the US dollar, which also seems to be in a bit of a free fall. Also talking international markets, which are really starting to outperform the US. Back half of the show, we're shifting our focus more into the resource stock sector, recapping some of those conferences in Toronto and some of the opportunities our guests see in some of those equities. We're kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies. Rick writes the institutional newsletter, Supposedly Irrelevant Factors. This is read by some of the most successful hedge funds in the world. And on the retail and individual side, I'm sure what a lot of you, our listeners, are interested in, check out In the Know Trader, that website. Rick has two products now, a weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. Rick, let's start off with these markets. As I said, they are in correction mode. Not quite at a 10% correction yet, but the S&P down about 7-ish% from its recent peak. I know a lot of money rotating out of the big name stocks. And Rick, I need to give you some credit that you called the market top. You forecasted it actually months before it came, outlining the level you thought the S&P would top at. Now that we've hit that top, Rick, just give us an overview of, again, what led you to call that top of the market and now how you think this could all play out.
Well, Corey, it goes back to pretty much about July 1st last summer when the S&P was probably trading 550-ish, something like that, the spiders rather. And as we saw strength at the end of June into early July, I had come out with a call telling people that the market would likely top. I had a projection target at 609 and high change, we call it 610, 609, something there. And we hit there first in December. I think it was December 6th was the first time we got to the 609 handle. I think probably 7-8 times we saw highs between, let's call it 605 and what ultimately became the mid-February high at 613, which was only 0.5% above the target. And now we've, fallen like a rock since mid-February. And today we potentially are closing beneath the 200-day moving average for the first time. Qs are beneath theirs already. And I think we're getting close. Today's low is awfully close to what was the July high. And the July high was significant, both for the S&P and for the Qs. The Qs sold off 16% from their July high. The S&P far less, I think, was probably closer to, 7%, something like that. And it's, we've sold off now to where there is some support. I think it wouldn't surprise me if we still tuck underneath this. I'd say for a tactical target, you're talking about below 560s to maybe 558 or so. And the S&P, so that that's only about 1% lower from here for a potential bounce. But I'm still looking in general that bounces will likely be sold into. At this point, I think north of 590, the S&P would have trouble if it could bounce that much. And anywhere from 590 to 595, something like that is the bulk of the resistance right now. And I think the market's still in for some trouble. And part of this is understanding the game of positioning that is out there. And so few investors understand that much of price movement is based upon who and what is positioned where and when. And the fact, if you look at how much buying came in after election night back in November, the big gap up when Trump won, and the amount of volume done over the 3 months that basically traded between spiders, let's call it 585 and 610, and now the breakdown underneath 585 just over a week ago, all those late to the game buyers are completely trapped. And I think it's going to take, a decent amount of time for them to get that money back and the chance to even, get out without a loss on it. Now, if you're a long-term investor, sure, ultimately it should come back. But the question is, how much are you willing to sacrifice on the downside for the hope that it comes back, and how many years, months, years it would take before that would happen. Some people would tell me, you're crazy. In another week we can be up at 595. And the way things are going right now, with the increased volatility and a VIX at 24, and the fact that you have a president who says anything at any time, CEOs don't know what to do right now because they simply don't know what Trump is going to say. And I generally try to keep politics out of this. And I'm not talking if I'm pro-Trump or against Trump. I'm just saying the reality is you have a president who right now is a difficult person for people to try to get an edge on what he's likely going to do, despite that he has said he would do many of these things during his campaign. The fact that they come at any time, any place, he announces tariffs, and he pulls back, and he pulls back more. He was against ever doing anything with Iran. Now he's talking about possibly coming to the table to discuss things with Iran. You just don't know what and how, what to do with this. So it comes back to understanding, take this out of the equation, all the positioning, who's doing what, how much, where is the smart money, and what is smart money doing? So if you turned on the TV to a business channel in the last month or two, you would know that Berkshire Hathaway has more cash than they've ever had. Steve Cohen, owner of the Mets, who has his 0.72 hedge fund, is negative the market. Stanley Druckenmiller is negative the market. Now, he's been negative for a while, so he's missed a lot of this. But a lot of smart money has been seeing distribution while the public was buying the last several months, especially since the election. And right now it's panning out that the public bought the top, which they so often do. And there are many times you take, whether it's CNBC or the like type channels where the public gets a lot of their information, they tend to be, what's the word you need, like carnival barkers, essentially at the top and the bottom, and mostly at the top. So look at how few guests were on who were bearish in the last few months as compared to bullish. And then people who've been bullish pretend like they haven't been bullish, because now that the market comes off, they're saying, well, yeah, we saw this and the market's coming off and it could come off more. And they just try to cover their rear ends for the fact that they are part of the reason that so much of the public is trapped on the top, is because they were gung-ho bulls over the last few months, and only now are starting to say, yeah, well, maybe we can pull back. That doesn't help anybody. But if you could foresee the distribution and what was actually going on, you had a much clearer signal that smart money was selling as compared to buying. And I think, that's the type thing that you need to know who you're listening to, and you probably need to spend a heck of a lot less time listening to talking heads on business television who generally are talking their own books and very little else besides that. And there's always the slant towards, the upside. And our work's been showing for months and months, not only where the target would be, but then once we hit it, the distribution over the last few months has been very easy to see. And that rallies have, continually failed north of Spider 600. And now you get the big, this is the third week in a row of like real selling. You can easily come up with potential support levels on the way down because we've moved up so much. There are lots and lots of support levels. But if you're going to ask me where I target, and I know you're going to ask me, so I'll just answer it for you. I think we likely get sub 550 on this move. And I give a 30% chance, and this is kind of really out of left field, and more than I ever looked for, because when I first put out the 609 call back in July, I said from there we would fall double percentage points, and it's meaning at least 10%. And my guess is we decline 11% or more. But on an outside chance that things really get much worse, I'd say there's a 30% chance the S&P could fall as low as, I don't know, something under maybe between 490 and 480 in spider terms. And that actually takes out last April's low.
Well, Rick, that's a pretty good setup for where things have been. With the top that you saw, you nailed it there, and you'd given the price target to our audience a couple of times in prior calls, and I appreciate you being one of the voices of reason, not just looking at the technical levels, but also the psychological side of the trading. And you kind of wove in the post-election sugar high that we saw, and then the talking heads on financial TV saying buy, buy, buy. But I appreciate that you're multiple input factors when you look at the markets. You look at the fundamentals, you look at the technicals, you look at the sentiment. But when you see these kind of moves, is there anything that you also would take away from some of the rotation out of some of the tech and growth names and into some other sectors? Because I know you follow a lot of the key spider ETFs in your service. Have you noticed more of a focus from growth to value in some of the sectors that you look at?
Well, sure. In the last 2 months, you've seen a rotation towards cyclical type names. And the biggest beaten down area, which was healthcare, right now is kind of on the best trajectory going forward to potentially actually outperform. It's still not outperforming on a year over year basis, but it is certainly improving the most out of any of the beaten down sectors. And along that line, you have materials, REITs, staples, and energy that are at least pointing towards potentially being where you're getting next leadership from. Hard to think that way, but if we get more into a true correction and we get the 10% or more to the downside, you're going to see those are the sectors to look for. And what you wouldn't look for are what the previous leaders were, which were, let's say, the three dominated by the Mag 7 names. So that's XLY, consumer discretionary, XLC, communication services, and XLK, tech. So those are kind of headed in the wrong direction. The only one of those three that still is, well, the standout of those three is still XLC. So that's Meta and Google being the two biggest names in those ETFs.
Rick, one of the big picture themes that I've been asking a lot of people about, which also ties into this pretty quick fall in the US dollar, is the potential of the end of this kind of US market dominance when you look around the world. The US markets over the last 10, maybe 20 years have just been absolutely crushing the rest of the world. The dollar has been relatively strong, especially recently. But if we are really seeing this deglobalization and quite frankly, the US picking fights with a lot of different countries, is there a chance, tying in the dollar and the outperformance that we have seen recently in international markets, that this could be a longer term trend where the dollar loses some of its purchasing power and these other markets that have lagged the US have a longer period of time to play catch up?
I think it's too early to know if that's the case. The dollar this year has been pretty much straight down, this week being the worst of its declines, because last week dollar index closed out at, I don't know, somewhere near 107.5, and right now we're at 103.70. We're down almost four full figures in a single week. It's been a long time since the dollar took that top of fall. Quickly looking, it looks like it could be something like the fall of 2022. The dollar broke out above about 107.5 or so last fall, got to 110, and then so far now it's sold off. And it's right now, dollar bearishness has gotten pretty decent, such that I actually think that we're pretty close to a real low, or at least a trading low. Somewhere around 103.5 is the 62% retracement level of the rally that we saw versus, so this year's high, let's call it 110, to the 2023 low, which was down at 99.5. Right now, here at 103.5, you're kind of at, a major support level, and anywhere from there to 102.5, I'd say, is going to determine whether or not the dollar actually continues falling and comes back and tests the 100 level, which it just bounced off of last year, or is this the bottom of this 2.5-month decline and things turn around and actually extend higher to get towards those 2022 highs, which in the dollar index was above 113. I mean, I have a measured target up to 112 and change. So you're kind of in the middle of nowhere right now, and it's too early to determine if ex-US, so whether you look at an ACWI world index like ACWX, an ETF, that's the old world country index for equities excluding the US, you get more specific towards looking at, let's say, one of the better European indexes to look at. The ETF is, the ticker is F like Frank, E, Edward, Z like zebra, Fez. That ticker is the Euro Stoxx 50, essentially the Dow Jones of European names, the top 50 names in Europe. I'm long that index, and I've trimmed a little. A week ago, I trimmed a little. It's actually up this week, in a week that the S&P is down sharply. So Europe is, for the first time, over the last few months, let's go back to the beginning of this year, Europe is outperforming. And we haven't seen that for a while. And there are periods of time that they do. Longer term, do I think that's likely going to hold? No. Could it last the whole year? Sure, it could. Depends on, how bad things get in the US. And again, how the implications of these tariffs, how much will other countries make the determination that they can't count on the US and therefore start making, economic deals with other parts of the world, which could end up being, US competitors like China and, maybe Russia. It depends on the goods and the needs they have. How much does Europe start trading with itself? How much do non-developed markets, emerging markets, start using places other than the US? These are up for grabs. And I think the dollar pullback that we've seen, although pretty darn sharp this year, because it's in the neighborhoods of 6%, something like that, which is pretty dramatic this quickly, it's just too early to tell how lasting this is. And part of that determination is because you have a guy like Donald Trump, for all his good and all his bad, I don't know if he changes his mind every day, but he seems to be the type guy who just kind of says what he's thinking at any given moment. And I think that's where markets are going to have a harder time dealing with somebody like that, because what he says on Monday could get unwound by Friday that same week. And, how you play that is very difficult.
Yeah, Rick, we've had people on the show mention that we're trading by tweet right now. It can literally change from one day to the next. But in that kind of an environment, do you think that there's a lot of foreign investors that have parked their money in U.S. dollars, but also in the U.S. markets? Are they fanning it out into other foreign markets now, like your point with Europe, but also some people have made the point with China? Do you think emerging markets will finally start getting a bid? Are we going to see some of these other markets outperform the U.S. market this year?
Well, again, it's going to depend, I think, ultimately on what the real direction in the dollar ends up being. If the dollar keeps falling, sure, you want to buy emerging markets. And from, technicals or positioning point of view, I can make a small case that, let me see, something like, what's a good proxy? EEM, right, is the popular emerging markets ETF. On the upside in 2024, kind of reached targets. On the downside, at the start of this year, it reached what I call a failed sell signal, and a failed sell signal is bullish in a generally uptrending market. So you can make the case that EM or emerging markets in general can do well, especially if the dollar breaks further. If the dollar holds in here, like I think it might in this mid 103 handle to 102.5 handle, then these may not have a heck of a lot upside. I think you're really going to have to wait to see which way the dollar goes.
Okay. Yeah, well, hey, to your point, I think the dollar's down over 3% just this month, and we're only a week through this month. So it really picked up some steam and, in a way, is kind of overdue for some sort of a bounce. Let's go to some other markets that we like to touch on, gold being one of those. Gold went through a little correction, but that's all it was, a little correction. It's back above 2,900. Obviously, still getting some of that defensive money play. The dollar weakness, I'm sure, helps to keep that dollar higher. A lot of people are saying $3,000 gold is inevitable. It's right around the corner. It's coming tomorrow. However, it hasn't gotten here yet. But look, gold, out of anything, has been pretty stable at these higher levels as these markets have been correcting. What are your thoughts on gold and any life in the gold stocks you're seeing as well?
Yeah, so let's kind of talk about bullion first. I think that gold's going to likely put in its high between 3,000 and 3,100. I've trimmed some at 2,700, which I've had for years and years. So although that trim was right for 2 weeks, and we went from, so when I trimmed at 2,700, we went to 2,800, and then we got to about 2,550 or something like that. So it was the right time sale, but I wasn't really looking to go back into it. And I could have or should have, I don't know. But I don't think gold has a heck of a lot left right now. It's already hit some really long-term targets. And that doesn't mean it has to stop. But it implies that if you're first buying gold at 2,900, the likelihood that you have drawdown, let's say, where's the next $500 up or down? I would tell you it's down. I don't think, if you bought gold at 2,900, I would say you have a much better chance of seeing $2,500 gold than before you'd see $3,400 gold. And that's part of what you need to understand when you buy anything, whether it's gold or a stock, is what's your upside versus your downside. And where are you in the scheme of all the other players in the market? If you look at the move in gold from, let's call it 2,600 late last fall to all-time highs now, just shy of 3,000. I use futures, so just about 2,975 is the all-time high. Once we put in the high, you have not really seen open interest move up, which means that you've also had much of the buying where shorts getting out to prior longs getting out. So the shorts got squeezed, they were on the losing side, and prior longs were selling out to the shorts who were forced to pay up. Open interest has been falling for the last month or so. So that's already indicative of the fact that this move is, in a classic interpretation of market movement, it's being fueled by shorts who are forced to pay and smart money selling out to those shorts. It's not indicative of new money coming into the gold market thinking prices are going well higher. And that's just one of the pieces of the puzzle that I look at when I analyze markets for my institutional clients is, who's doing the buying, who's doing the selling. And it's pretty clear that recently it's shorts getting squeezed out. So that's part of the reason why I don't think gold necessarily has a heck of a lot left in it.
What about the equities, though, Rick? Do you think that they could play catch up to where the gold price is, even if it pulls back a little bit? Because some of them have still underperformed people's expectations and what they would do. But then again, the equities are different than gold. So how are you looking at those separate from gold?
So, for a long time, for years, we've heard that gold equities are terribly undervalued to bullion itself. And yet, since, I don't know, the peak in 2020 of the ratio, if you pulled up a chart of GDX, which is the predominant gold equity ETF, divided by GLD, the popular gold bullion ETF. This peaked in 2020. So it first sold off and made a huge bottom when COVID came out. Then it reversed completely, where GDX took over and had a huge rally versus bullion. But from the middle of 2020, this has basically been every rally you could sell if you could figure out where to sell. This is just lower highs, lower lows. But the low made right about at the turn to start this year was precisely on the uptrend line that goes all the way back to the big secular low from 2016. That now has 4 points on it. It takes 2 points to draw a trend line. 2 more times this ratio has come back to precisely tell you when to buy GDX versus GLD. So for right now, you would lean towards the equities doing better than bullion until that trend line really gave way. But we have not seen any sustainable rally in GDX versus GLD. I mean, sometimes it lasts a year, but it has not been a bigger, longer term trend where so many people have gone into looking for a gold equities to outperform, and they just haven't for several years in totality. So near term, yeah, I'd still lean towards GDX doing better than GLD, but also do remember that GDX, you're still talking equities, and the equity market's under some pressure now. But just looking at those two against each other, I'd give a slight edge to owning the gold equity as compared to bullion.
Interesting. Okay, so hey, maybe gold moves sideways, maybe it corrects a little bit more, but the equities do okay in that environment. Rick, one other point that people have brought up looking at something like GDX, even GDXJ, is that the volumes have been quite low in those ETFs. Do you put any weight in that? Should we be paying attention to volumes?
You don't need to if your goal is making money. If you can figure out when to buy and when to sell, what's the difference how much volume was behind it?
What about showing interest in the sector, though? I like your comment there. That's a great comment, that if you're out to make money, who cares about volume? But what about showing potential interest or the increase that could be possible in interest?
Yeah. All right. So let's compare volume now since 2020 from 2015 to 2020, right? So we look back 10 years. For sure, the first 5 of those 10 years did far more volume than doing now, which means, yes, in general, less interest in the sector. Part of the reason less interest in the sector, you had cryptos come around, so that took money out of people looking at the gold market. And you had let's just use generically Mag 7 type names that really drew money into those names, whereby, if you're in gold names, usually it's just a fraction of your portfolio. You have far less generally, unless you are running a gold fund, you have far less in GDX and GLD and just, let's call it gold and gold related exposure. When the market's flying and you've got names that, look at NVIDIA 5 years ago where it's priced now, right? Look at Microsoft, look at Apple, that's what you want to make money. It all comes down to what's your goal? Where do you want to make money? And, I think of gold the way I probably thought about it 30, 40 years ago when I first got into the industry, which is, it's a hedge against inflation. You should have, a small percent of your overall portfolio there, just kind of as a hedge. It's done well for sure since 2000, the last 25 years. It's pretty much matched what the S&P has done, which is phenomenal. But people don't have 20% of their portfolios in gold and gold equities. You just don't. So it's a smaller piece of the puzzle just to begin with. And when you have the global coverage that the last few years have brought to Mag 7 type names, but why are you looking to hope to make 3 or 4% in gold if you can make 100% in, something on the equity side. So it's all part of the puzzle too, is the last 5 years, gold's probably, GDX volume is probably half of what it was from the prior 5 years. But that doesn't stop the market. Look at a GDX chart. It goes up and down. It's choppy as all hell, just like it was in the past. So no listener is going to be affected by the fact that there's half as much volume as there was in the past. You'll be able to buy and sell anything you need to do whenever you need to do it. A bigger picture of saying, there's less interest in this. And a lot of that is because of crypto.
Well, Rick, I appreciate you breaking that down. We do have people in our audience that probably have a bigger allocation to the precious metal sector than your typical generalist investors do. And some of them make the point that if you look at things since the turn of the century, after the dot-com bubble burst, 99, 2000 and forward, that gold has still outperformed the equities. And even this year, gold has outperformed the general equities. And really, it depends on where you start your measuring stick, like always. But there's some people that just have a bigger allocation. But I think you're right that a lot of the last 5 to 10 years have been a change in tone over to other sectors that are hot, the tech sector and the cryptos. I'd love you to weigh in on the cryptoverse and Bitcoin. Some people have an outsized allocation to that as well that are just diehards in that sector. I know you only keep a small allocation, but how are you looking at something like Bitcoin?
So you heard me say it on your show months ago that the upside target I had for Bitcoin, and I use futures as my proxy, was 108,800. And what's the all-time high? 110. 110, 150. All right, so same thing, 1% away, give or take, was a number I came out with months and months before we ever got there. It's got a big rounding, same thing, post-election, huge rounding distributive top, and then into, I guess, about a week and a half ago or so, futures got down to 78,330, which closed the gap from election night. So now we got as high as 95,000 about a week ago when we had that good news where Trump said, he's going to make the crypto strategic fund. But we opened pretty much on the high and closed on the low that day, and we haven't done anything since then. So you still have months of trap buyers. Same way, if the chart's similar to the S&P since election night. You had the huge run up right after election day, a big distributive top that lasted, 3 to 4 months, and now the move down. So you have trapped people above. You've got good news out in the crypto space that did not act positively in the market. So for me now, you need to get weekly closes or, certainly several daily closes above, let's say, 93,005 and a quarter in order to think that this thing has any chance to move back up. But I'd say right now, just based on positioning, the public again bought the top, and right now they're kind of trapped. So, there's major support down here. I don't know, let's call it 70,000, something like that, down to 63. I'd hope not to see that. Just because I have a very small position myself out of my whole portfolio. I'm not even at, I think, 1%. And in hindsight, I guess it would have been better if I had 20% in crypto from years ago. Because, if you weren't Bitcoin, you would have done phenomenally. But I still don't necessarily buy the story to it. So I have some, and I've made some money in it. But right now, based on positioning, kind of, you have a fair amount of people trapped. And I'm not sure what the catalyst is going to be to untrap those people, given that the news is already out that Trump is, thinking of this whole strategic reserve with cryptos. So it's going to need something else to happen in order to see Bitcoin get back up to its all-time highs.
I'm with you, Rick. That signing of that order this week and seeing crypto sell off on the back of that, I think that was a real wake-up call, or it should have been to a lot of traders really playing the crypto space. I understand having an allocation to it, but look at that, I thought would be a huge driver. It was when it was first announced, but now when the pen met the paper, traders went a different direction. Very interesting to see those market moves.
I mean, let me just say, I bought $85,000 and sold the open. When was it? Last Friday when that announcement came, it was 95. So I made a quick, it's a fraction. I didn't buy a full Bitcoin. So it's not like I laid out $85,000 and made 10 grand on it. I bought a fraction of Bitcoin. I played a quick trade. But when I look at the bigger picture, I know it's supposed to, your crypto bulls are saying it's going to be $250,000. People say it's going to be $1 million. I have no clue. But right now, there's a lot of people trapped in this. Months of buyers with no likely exit to not lose money on this.
Hey, so interesting. Rick, hey, we've taken up a lot of your time, but boy, oh boy, do I find it always interesting and always insightful chatting with you. Again, if you want to learn more about Rick's retail and individual letters, visit the In the Know Trader website. I will post that link in the show notes of the weekend show. You can sign up for the Tactical Trader Report or the Daily Tip Sheet. If you have any further questions, feel free to email either Shad or I about Rick's services. So Rick, always great chatting with you. Thanks for taking time with us today. I hope you have a great rest of your weekend.
You too, guys. Thanks for having me.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the KE Report Weekend Show. And as promised, we're now switching our focus to the resource sector because, well, it was a busy week for a lot of our regular guests on the show. In Toronto, we had the Metals Investor Forum. And at the beginning of this last week, we had the PDAC conference, so the largest resource investment conference. In this segment, to recap those conferences and talk about the overall metals stock sector, which had a nice bounce again this week, we're chatting with Brian Leni, founder and editor of the Junior Stock Review. Brian, let's start off with those conferences. You were in Toronto. You attended the Metals Investor Forum. You also attended the start of the PDAC. What did you see there, Brian? What was your general takeaway from those conferences?
Well, first, thanks for having me, guys. Overall, it was a great weekend or 4 days in Toronto for MIF and PDAC. I think I can answer that question from two different perspectives. I think first, from a sentiment perspective, I think that it was still a little bit light from a retail point of view. And that's sort of after spending 4 days in Vancouver in January. I was really intrigued about what I might see, a couple months later with the gold price being as high as it was. I was hoping that I would see a big retail contingent, and I don't necessarily think it was there. But what I would say is that the people that were there were new to the sector and were asking some great questions. And so the quantity may not be there, but the quality seems to be ticking up. And I think that's a great thing to see. And that's probably reflective of where we are in the market, the very early stages of bull market, and a sign of good things to come, I think. From my own perspective, again, I think this is probably the best PDAC I've had and MIF conference I've had. From a meeting perspective, from probably the quality, and again, it mixed in with the early stages of a bull market. I think the optimism that sentiment rubs off, and so I don't think I've been this optimistic about the market in a long time, and that's a great thing to have.
Well, Brian, did you notice any trends as far as the companies that were there, or as far as what investors were interested in, as far as, is there more focus on just gold since gold has done so well? Was there any interest in copper, silver, some of the other metals? Was there a disdain for uranium companies? What kind of vibe did you get as far as what was in and what was out?
I think that gold definitely stole the show at both places, both conferences, and rightfully so. I think that's the best opportunity for investors that are looking to deploy money into the junior resource sector. I think that, gold probably represents maybe not the most upside from a metal price standpoint, but probably offers the best risk to reward, meaning that the downside risk, I think, in the gold price is probably pretty low. And the upside, who knows how high it could really go. And so from that perspective, investing in the developers, explorers, producers, I think is a great thing, and if you can pick the right companies again, it's probably where the best risk to reward is. Next to that, the silver bulls are always there. I've heard numerous people talk about silver's next. I'd like to think so. There's definitely some exposure in the junior stock premium portfolio to silver, but you just never know. Silver has definitely changed over the years. It certainly is more of an industrial metal. And as such, its dynamics are that much different from gold. Outside of that, in terms of energy and the other commodities, not a lot of talk. At least around me anyways, critical metals is definitely always a big topic, but I didn't hear very much on that front. And maybe that's a sign of a bottom or a sign of where the opportunity is in the market, considering all that focus is on gold. But like I said, I still think if you were looking to deploy money right now, you'd be foolish to not have some exposure to gold. But, as such, we were talking offline there. I just made a new pick in copper. And with the future price hovering up around $5 a pound, sort of, in a stealth mode, because I don't hear anybody talking about it, maybe there's some opportunity there, especially with all this chaos created by tariffs and bad blood between countries moving forward. Maybe that's the opportunity.
Brian, I want to revisit a comment you made there that this could be early stage of a bull market for especially precious metals. And look, you are right. The focus for resource investors, especially on the stock side, has been very much to gold. Gold has stole the show because it keeps on hitting all-time highs and just keeps on moving higher. We haven't seen the whole revaluation of all the gold stocks, but a lot of producers, a lot of mid-tiers have done very well over the last year because it was a year ago at PDAC when the gold price truly started to break out and really hasn't looked back. But we can also go back 10 years and the gold price is up almost 3 times. So when you're talking early stage of a bull market, are you referring to the smaller stocks that haven't moved, or how are you putting that time frame on it?
Right. Oh, so when I say that, I mean like that tide that rises all boats. My experience with gold bull markets primarily are 2016 and 2020. And in both cases, for about 6, maybe to 8 months, that push in the precious metals, mainly gold equities, was sort of unparalleled in my experience. And it was something that, you saw all share prices across the board, no matter if it was your mediocre or, bottom basement companies to the best of the best, were moving up. And that's what I'm sort of alluding to in terms of like a full out bull market, because I think you're right. If you picked right, which I did last year, like the junior stock premium portfolio was up, had an average weighted return over 150%. The last time the premium portfolio did that was in 2020, and that was in an all out bull market. So you could say from a performance wise that it's sort of paralleling that. But what I will say is that definitely from my perspective, and I think this is any investor could sort of have this experience, that it's a constant learning experience. And I made some mistakes myself, but I made a lot of good moves over the last year and a half, and that was precipitated on the back of failure. And so I learned from a lot of my mistakes and positioned myself really well with the newsletter and my own investments. And so I was able to reap the rewards in what I would say most would consider would be a sort of medium year. So again, if you pick right, you can still have good performance. And it really, if you look at the way I constructed the portfolio, and again, this is something that we were sort of talking offline, the reason why I got into exploration the way I did, if you look at my the premium portfolio right now, there's good exposure to exploration, but it's exploration exposure through prospect generation. And I think I've picked the cream of the crop when it comes to prospect generators. And all those companies are going to see multi-million dollars worth of exploration, mostly drilling, in last year and then into 2025. And so from that perspective, when you look at exploration, if discoveries are made, it doesn't really matter where you are in the cycle. You will get paid if they make a good enough discovery. And so that's sort of the balance that I've taken in the portfolio and why it performed last year. And I expect it could do even better this year. And if you look at the performance, really, it almost done Q1 here, and it's kind of keeping up the pace that it did last year. So portfolio construction can help you no matter where you are in the bull market. But of course, when you get into those bull market opportunities or settings, it's a tide that rises all boats. And that's the sort of what everybody, an investor, no matter where your experience is, can make some money. And I just hope people last to sort of experience that, because it can really, set you up with a nice buffer for that next X amount of years of your investing career.
Well, Brian, let's pull on that thread a little bit, because when I think of the Junior Stock Review and the letter you put out, I consider you one of the best voices in the sector covering the development space, as far as companies that maybe are a little more advanced and they have resources defined and economic studies, but you've gone down the food chain into more exploration than in the past. And you're doing it, like you say, through some exposure to prospect generators. Now, prospect generators are a charged topic. Some people hate them. Some people love them. Rick Rule swears by them. Other people think, they got a lot of pieces of a lot of product projects, but no main flagships. Some companies, though, do have 100% owned properties that they're drilling. So parse out how you separate the wheat from the chaff in the prospect generator space, and what kinds of companies or what the hallmarks you look for in a prospect generator.
Sure. So first and foremost, I think the overarching point of investing in a prospect generator is to reduce risk, to protect your downside. That's sort of the overarching theme. From there, I think it's just like any other company out there. You have to make sure you pick the right ones. It's not a ubiquitous buy that you buy any prospect generator out there. I think I would tend to agree that probably about 75-80% of the prospect generators out there are boring and are sort of meaningless, because they have 20-30% of projects that just don't have any potential. The difference is if you can find the companies that have already made a major discovery, or are probably on the cusp of it because they've used their geological acumen to identify high potential targets, and then went out or sought out companies with big checkbooks to explore them. I think you're at a huge advantage. And again, if you look at the companies I'm invested in, I'll talk about, Kenorland Minerals. These guys, especially when I started buying the company, in the 60s and 70-cent range, they had already made the Renault discovery. This is going back to last year, they converted their 20% position in Renault or Frotet into a 4% NSR. And again, if you do some simple geometry, and again, this is very super rough and you don't want to put too much emphasis on this, but I can totally see how it's a multi-million ounce deposit. Therefore, a 4% NSR, even with a buyback down to 3.5 or 3.2, whatever the buyback is, you're still looking at something that's probably worth at least $100 million. So you are buying Kenorland for right now market cap of around $100 million. Therefore, you get $30 million in cash. You get $36 million in exploration spend in 2025. And I would say you've got arguably one of the best exploration teams in the business for finding gold undercover. So you look at how they've set up that company, you see the opportunity. And so to me, that's a no-brainer, or as close to a no-brainer as you get in this crazy sector that we invest in, speculate in. It's protecting your downside. It's picking companies that are selling for less than they're worth, but that selling for less than they're worth, it's actual value that you're buying. It's actual discoveries, or it's actual potential that you see in that project portfolio. And that potential is going to be tested because they've been able to attract smart money. They've been attract, those senior mining companies to deploy and test that potential. And I think that's all you can sort of ask for. And so it's that balance between prospect generation or exploration and development that I've tried to take in the portfolio in case I'm wrong about where the direction of the market is headed. Because I thought to myself, these developers, and what I've experienced is if the metal price isn't with you, it's much harder for you to realize value from the market in those cases. Therefore, you need something in the portfolio that sort of can drive alpha regardless of where the market is headed. And to me, exploration is the only way to do that. And again, I want to take it a step further and say, I want to protect my downside, and then prospect generation fits. So that's sort of how I look at the market. It's sort of how the portfolio has been constructed.
Well, and it makes sense with a prospect generator. The partners you want are the larger mining companies. They are not as subject to market swings like juniors are that would back away from assets simply because they can't raise money. But look, Kennerland, we've talked about it before. The company listed back in 2021, they already had big companies as partners, right? These guys did a great job, even as a private company, attracting large companies. So that, in a way, I agree with you, is kind of the no-brainer for prospect generators. But I don't think there are that many prospect generators that even have that Rolodex that Kennerland does with those type of partners. Are there any other prospect generators that also stand out to you that, again, have those majors, maybe that haven't even made a discovery yet, quite like Kennerland? Kennerland's much further advanced with that royalty, with discoveries, but any other prospect generators that you see that have those at least similar partners to Kennerland?
Absolutely. And from my portfolio right now, off my head, I think I've got 4 or 5 in the portfolio, and each of those have exposure to the largest mining companies in the world. To give you another name, and I think it's actually quite interesting, their share price hasn't moved a tremendous amount considering what position they're in. But a company, let's say like Inflection Resources, they've been able to attract AngloGold Ashanti. They're exploring in the Macquarie Belt in Australia. They've got, I would say, arguably the best deal with a senior mining company out there in terms of how JV projects will be explored and developed. If you look at the breakdown, they basically have at the phase 1 level, you've got, I think it's $7 million that needs to be spent. And then from there, projects get picked for phase 2. And in phase 2, you have another 7 to 10 million that's spent in phase 2, and then they go to a phase 4, which is a feasibility study and the issuance of a 2% NSR on the project. So these guys essentially, if they discover something in phase 1, 2, or 3, and they develop it up to phase 4, Inflection is carried all the way up to a PFS, which is a huge deal. And especially if you look what they're looking for in the Macquarie Belt, they're looking for these large porphyry discoveries in line with, let's say, Acadia, which is a massive porphyry discovery in the Macquarie Belt. And again, if they got something like that, you're talking hundreds of millions of dollars in development costs and exploration costs to get to the point of a PFS, which means, I think, and again, I don't think I'm stepping out and being too crazy, but it means that if they make a discovery, pretty much Inflection's going to get taken out. And again, you don't see deals like that with senior mining companies very much. But this is the importance of thinking big, big properties, big structures, big potential. It doesn't speak to saying 100% you're going to make a discovery, but you've set yourself up that if you do, you're probably going to discover something of significance. And this is exactly what the senior mining companies are looking for, and is why a company like AngloGold, decided to do this deal with Inflection, because it's such a good idea. And the tract of land that they got in the Macquarie Belt is sort of unparalleled. So again, if you look, and this is sort of a teaser, because I do think I've done a very good job with the newsletter, grabbing the best of the best prospect generation companies out there. Each of the companies that I have in the portfolio have exposure to that, and in their own nuanced way. So again, it's right now with the market the way it is, it's a stock picker's market. And I think I've done a great job in sort of assembling the portfolio to gain that alpha if they make a discovery. And the other side is if we continue to have this hotness in the gold market or across the sector, those development companies that I have also have the right exposure to bring that alpha to the portfolio. And again, that's what I think you want to look for. The only other topic that we could kind of cover is portfolio allocation. You can have exposure to exploration, or you can have exposure to prospect generators and developers, but you can also change the allocation. So you can have your investment. Let's say I'm headed to see AbraSilver's Dublilos in April. AbraSilver's been a huge winner for me. AbraSilver still represents roughly, I think, around 11.5% of my portfolio. That is a company that may not be a 10-bagger from where it is today, especially if the silver price or the gold price doesn't continue to run. But I could see it definitely double from here. And if I doubled a position that's 11.5 or 12% of my portfolio, I can still make the same difference or the same margin of profit as I could if you took an exploration company or a prospect generator that's a 2% or a 3% allocate a portion of the portfolio, and they make a discovery that brings them 3 or 4 times. So you see, portfolio allocation can also be a way that you protect yourself and gain some alpha if you want to go into the riskier companies, even outside of prospect generation.
Man, Brian, that's such a interesting point, and I'm so glad you brought up how you do that inside of your portfolio, the allocation, the weighting, because I have the same philosophy personally, that some of the better companies could double or triple, but if they're a bigger position size, that would be like a smaller company that's a smaller weighting going up 3x, 5x. You can still have that same kind of overall alpha in your portfolio, but you're also managing risk at the same time. I kind of want to stick with prospect generator on just one more question here, though, and that is there's a couple different pathways. It's not a one size fits all space. So there are prospect generator companies that do play for the takeover. So like what you're saying with Inflection Resources, or even their sister company Headwater that's doing the same kind of model. Yeah, they hope that they get taken over by the major. But there are prospect generator companies that also hold 100% owned properties that they drill themselves, and they're hoping they don't get taken over. They're hoping to sell the project. And then the third model would be what you see in the royalty space for prospect generators like Elemental Altus, the Altus part of it, or like EMX or Altius, which I know you're very familiar with Altius. They all started as prospect generators, optioned the properties off, kept the royalty, and in the end, EMX and Altius and the Altus Elemental merger now, they're all royalty companies that use the prospect generator model to grow. So I guess between those different flavors, do you like the ones that are playing for the takeover? Do you like the ones that hold 100% properties? Or do you like that some of them become royalty companies over time?
That's a really good point, Chad. There definitely is a differentiation between those like various, they're like hybrids, right? And I do actually, and I would consider it, it's like, because I see it from both sides, I would consider the hybrids to be like, let's say Ridgeline. Ridgeline's done exceptionally well. They're in the portfolio. They've got a ton of potential, 3 projects that are JV'd, 2 that are 100% owned. And when I first made the investment decision, like I've known Chad for a while now, but I got to invest in the 12-cent placement last year. I thought that was tremendous value. And that's when they only had basically the 3 projects, or it was 4 projects, but the 3 main ones that we're seeing spend on them. And that was with South 32 and of course, Nevada Gold Mines. I would say that they stand out that with that hybrid model, because Chad is going to go after their new Atlas project. He's going to drop some holes in there. I think they're a great low risk hybrid model because, Chad's experienced the other side of things where, when Ridgeline first started, they were not a hybrid or they were not a prospect generation company. They were a full out sole explorer. And it's super tough, even when you have projects like Selena that have so much potential, this CRD potential at depth. And they took a couple swings and they did a couple 700-meter holes. They hit some mineralization, but the market still didn't want to give them any attributable value to that. Maybe because of how hard it is. If you start thinking about how much money needs to be spent to effectively drill projects, especially big projects with big potential, maybe the market rightly discounted it. So he sort of on the fly switched the model over the last year and a half. And I think he's put him in such a great position, especially now that he wants to go take a few swipes at Atlas on his 100% ground for cheap. He's going to put in a few RC holes and he's going to test that Carlin type gold mineralization potential. And to me, that's worth doing. And I wouldn't even be opposed to companies like Kenorland doing the same thing. And I'm pretty sure that Zach has at least one hole planned at their Canicross in Alaska. I believe he's going to drop at least 1 or 2 holes into the Skarn target that they have there. I like that. I sort of like that. They've built a really good business and really good downside protection with their JV projects, and then something that they feel really passionate about and that's not going to blow the bank because they do have a good treasury. I think it's worth testing their geological acumen and see if they're correct and their assumptions, especially like that Tanacross project was last JV'd with Antofagasta. And I can remember the guys talking about, this Skarn target being so important to them, but Antofagasta didn't want to drill it. And so it was almost like a blessing for them to leave. And now they get it back and they get to put those couple holes in and really test, that potential that they saw from the outside looking in. So, I think that most prospect generators need to focus on JVing projects first and protecting downside from that perspective. From there, once they have a little bit of success and there's a little bit more downside protection and enough spend going on in news flow to sort of drive that share price forward, if they hit something, then they can go out there and take more chances. And kind of do that hybrid model where, they have a couple 100% owned projects, but again, it's not going to destroy the company if they miss. So yeah, I don't know if I fully answered the question, but that's sort of how I look at it. And so the companies that are in the portfolio, again, there's 4 or 5 of them. they sort of are in that realm of having either full prospect generation, or maybe they have a few projects or one project in particular that they're touching on that's 100% owned.
Well, and to your point about having some of those JVs already in place, it helps to cover simple G&A costs too for a lot of these companies. If they are the operator of these exploration programs, they get a little piece of the spend, and that helps, again, protect that downside. Brian, what about developers then? Let's switch to a little bit higher up the food chain. You always focus on developers. You love diving into economic studies and creating your models. There's been a number of developers that have moved very well in the last year. There's also a number of development companies that haven't moved, but I also think that there's so many more companies that are now considering themselves developers, simply because, well, that's the stage in the market they are. They have resources, and right now they're kind of stuck trying to figure out, should they expand their resource? Should they act like they're actually going to build something? How are you viewing the developer space?
I think you want to be really picky on what you buy. And I do think the cream of the crop basically moved last year. But there is still a few companies out there that are showing some great delta in terms of price to value. And so I think you want to stay, again, who knows where the market is headed. And again, I would say that my preference is towards saying that we're in the early stages of bull market and we could really see a huge push this year. I truly believe that's probably where we're most likely headed. But if we aren't, then you still want to make sure that you're picking the sort of best companies that you can, that have a realistic price to value ratio or delta that can be closed through market recognition. And you're looking for size, maybe potential, like in terms of X factors. A lot of these developers, of course, they've got usually a core or that critical mass where they can do an economic study and it shows decent economics, and you could plausibly say that this would go into production because of that critical mass. But maybe the exploration, there's some really good targets that are somewhere else on the property or within, let's say, a 30-kilometer radius. If it's another project outside of it, that realistic, if they made a discovery, could be added on, sort of that hub and spoke idea with a production facility. So that X factor that sort of separates them from the other companies. And if you look at the portfolio again, that's sort of how I've picked them. These companies have some sort of X factor that separates them from the other developers, and that the market is either oblivious to or has highly discounted it. And I can think of a number of examples, but I don't want to give up the whole portfolio with examples. If people are interested, I hope they'll consider subscribing. But that's how I'm looking at it. And I think, again, going back to last year, that was the key to companies like G Mining or Montage. Why those were, 300% wins in the portfolio is because they had X factors that the market wasn't really considering or giving them value for. In G Mining's case, the Gignacs, the power of G Mining services that took Tokenzinho, which is definitely not a top tier project, but they put it into production on time and on budget. And then they went out and bought Oko West. This is what you get with the best of the best people. And I think the market discounted that. On Montage's case, you had close to a 5 million ounce deposit that the Lundins were involved in, and they were listed on everybody's corporate decks that they saw. Yet nobody cared until the Lundins came out publicly and really made a statement by, how they sort of changed the company, and then the share price soared. So, there's numerous examples of that out there. And then there's sort of numerous examples of companies that kind of ho-hum, that there isn't necessarily that thing that separates them. And that's what happens in a stock picker's market, is you have to be able to find those things. And of course, if we are headed to a bull market, then probably everything will go up. And so it won't matter quite as much.
Well, Brian, just along that line of thinking, as far as looking for the X factors or looking for ways to kind of reimagine a project or find satellite deposits or, do something different. And sometimes companies have changed the mining method from open pit to underground or vice versa. So sometimes it just takes looking at it with a fresh set of eyes. You've already kind of teased that you're going down to see the Diablilos project from Abra Silver. Think about what a step change it was from them when they had a colto, known deposit, good enough to put into production, but nobody was really interested. Then they find the Jack Zone, which is this high grade near surface area, totally new area, spends 18 months drilling it out. They bring in Kinross, they bring in Central Puerto, and now they're moving towards a feasibility study and going to cash in on the RIGI laws down in Argentina. It was a step change for the company. Do you go through all these different companies you see at PDAC and look for the companies that are doing something new, something different, a new interpretation, or have a new angle on an old story. Because a lot of people get mesmerized by news stories, but sometimes the old stories were the news stories from 10 years ago. They're still good. So how do you look at that?
Yeah, it's a good point. That typically can be where you find a lot of value, is in the rejigs of these companies, especially when you have management changes. And then going back to Aber Silver, which was formerly Aber Plata, there's a couple of things there. It's a story that sort of got destroyed by turmoil with the management team. This is going back to 2017, 2018, if I remember correctly. Turmoil with the management team, Argentina being sort of a basket case jurisdiction. They had a lack of cash. The summation of those three things brought their market cap down to, I think, sub 10 million. And of course, they had a resource. They had all these other things sort of going for them. And then they combined with Aethon Minerals, John Miniotis and his team, and sort of the influence of the Altius guys come in, and the story was completely revamped. And actually, it's funny because I was talking to some of the Altius people, and they were talking about the Jack Zone, how before that deal was sort of consummated, that was an area where they thought a lot of potential was. So it's the culmination of that step change with new people coming in, a new eye on the story, a new way to develop. But then when things just get super cheap, it becomes almost a no-brainer at some points, as long as you have the fortitude to sort of, in that case, put your money to work in Argentina, where at the time where, you could have lost everything, even though it was cheap, it could still have gone down cheaper. So, definitely the rejigs are a big part of how I look at it. But again, it's a story by story basis, and you're definitely looking at those things that the market is missing. And most likely, I think you bring up the point rightly, is that these older stories kind of get pushed to the back. People already discount them, but those new eyes can make such a difference. And I'll bring up an example I'm not invested in, but could be the same thing. You look what Hyadon is doing with Corex. That project that they put into the rebranding of Corex, again, I forget the name, but you're basically talking the rebranding of a project that's been around for at least a decade. And obviously Hyadon had a huge amount of success already in the gold market. And so I give him the benefit of the doubt that he could probably do it in the copper market too, but he's going after a deposit that's very well known already. So he's got the market probably against him to a certain degree, which may make that project that much more appetizing for investors looking for value.
All right, Brian, you've given us a lot to consider here. Again, in this whole bigger picture theme of the market is running. It has been running for over a year now, but the breakouts have been happening in this last year ever since last PDAC. And yes, it has been very much a stock picker's market, but at least it's been a wider stock picker's market there, where there has been a lot of companies moving strongly in this last year. And yes, a lot of the focus has been on gold, which I guess rightfully so. That is the metal that has been drastically outperforming in terms of all-time highs on a consistent basis. As long as that continues, man, oh man, you probably are going to be right that we are going to get to that stage where it's a re-rate across the board and all these stocks move. Still helps to be in the best ones, but also very much sounds like look for some of these stocks that haven't moved yet. Again, Brian Leni, founder and editor of the Junior Stock Review. Brian, it's always great having you on the show. And everyone, thanks for tuning in to this weekend show. Please be sure to go back through our website, podcast, and YouTube channel. Just search the KE Report. You can listen to all our daily editorials and the full weekend show posting. Also, please hit like, hit subscribe, leave us your comments. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.